Hi, everybody. Welcome to another episode of the Entrepreneur Aligned podcast. I'm your host, Jarrod Musick. So today I wanted to talk about a topic that is going to be back in vogue here in the next year and a half or so, and that is utilization of different types of debt. So we've been in this time period since 2021 where we've had higher interest rates and interest rates which have been on the rise. Really to fight inflation. So we created a whole bunch of money. We gave a bunch of it away in different grants and loans and distribution programs. The thought being that we really needed to continue to keep the economy running with COVID and the slowdown in virtually everything that we did on a day-to-day basis. And it seems like that really overheated the economy, I think, is the general consensus. I think if you're looking, because we're in a political year, both parties certainly contributed to that, played their role in it, and we all get to own it now. But that move up in inflation has largely been curtailed. If you want more information about this, you can head over to destinycapital.com. We have our CIO mailbag and markets and economy updates, and we spent an entire episode talking about interest rates and inflation and where we stand here in fall of 2024. But we just had, a week prior to this recording, our first interest rate cut in a little bit over 2.5 years. So we're going to gradually start seeing the costs for borrowing going down. And as an entrepreneur, this is something that is really important to us because we utilize debt to be able to kickstart growth and allow us to expand our businesses. We utilize debt to bridge different projects in the business and personally. Let's say you're moving from one place to another and you don't want to have to sell going from one to the other. You might be using something like a portfolio-based loan against your liquid assets. You may have enough equity in an existing home that you're drawing on a HELOC. There are a number of other programs that you might be turning to on the personal side. And then on the business side, if we're looking at various SBA loan programs or just private loans or hard money loans for things like real estate investment, construction, et cetera, et cetera. The cost for all of those should be coming down. It won't be immediate and it won't be a one-to-one relationship with the Fed funds rate. So the Fed funds rate is one large, but still just one input into the interest rate environment and what determines the cost of capital and the cost of borrowing. So take it with a grain of salt when you see that the Fed has cut interest rates. That does not mean that the mortgage you're looking for is immediately going to be down in the same rate as what the Fed just cut rates. So we had our 0.5% cut. We're probably looking at somewhere between another 1% to 2.5% of rates heading down. Now, when we think about what the natural rate environment should look like, meaning it's not expansionary, and it's not intended to really constrain the economy. It's sitting somewhere in the middle where it's kind of like, yeah, this is 30, 40-year average of what the cost of capital looks like. The economy is not, it's not shrinking and it's not growing too fast. That's what we're talking about with the natural interest rate environment. And that probably means a Fed funds rate of somewhere, 2.5% to 3.5%. So we're in the high fours right now. And that number is going to be coming down probably over the rest of 2024 and 2025 into that target range. So when you're looking at cost of capital, it's a really great opportunity to reevaluate what do you currently have in terms of debt utilization, what do you need immediately, and what do you think you're going to need over the next few years. Particularly, let's go from kind of easiest to most complicated. Let's start on the personal side. Mortgage rates. If you purchased a home or had to do a refinance for some other reason here in the last couple of years, your borrowing costs were probably north of 6 to 6.5% on a fixed rate basis. If you did something like an adjustable rate mortgage on a shorter term, they might be lower. If you did something that was like an interest-only loan or a portfolio loan, something like that, you're probably in the 7+%. There's certainly going to be room for you to look at refinancing. This is usually one of the larger pain points for our entrepreneur families because depending on the lending institution, loan officers do not know how to understand a business owner's tax return, how our cash flow is generated, how to separate personal ownership and business ownership of various pieces. So if you're struggling with that, interview multiple lenders. ask for somebody specifically, hey, do you have somebody in underwriting who specifically works with closely held business owners or people with variable cash flows? You want somebody who actually is going to understand what they're looking at and be able to help you get the loan that you should qualify for, even if your tax return doesn't check all of the boxes that they're looking to see. So that's one. Mortgages, certainly if you have anything that's on like an auto loan or lease, those are going to be easy refinance opportunities. Now, if we also look at the personal side, one of the top tools that we see utilized by our entrepreneur families is portfolio-based lending and securitized lines of credit that are tied to portfolio assets. So we typically see this when entrepreneurs have started to generate significant cash flows in excess of what they need to grow the business and in excess of what they need to consume to maintain the lifestyle that they and their family want. So you're usually looking at this when it's, hey, I'm making $2 to $3 million a year, and I want to start putting some of that into a different place than my business. My business is growing and doing great, but I don't want all of my eggs in one basket. I want some diversification. And that's when you start to see utilization of brokerage accounts and outside investments. Now, the more liquid these are, they can serve as collateral for revolving lines of credit. Great tool. It can really back up like your business lines of credit, just personal liquidity and, needing short-term capital for various projects. But if you put them in place, those interest rates typically float and they're tied to a benchmark interest rate. Wall Street Journal prime rate is typically used for things like real estate. You're usually looking at a benchmark of SOFR, which I could tell you the name of, but I just blanked on it. It was the replacement for LIBOR, which was the London Interbank Offered Rate, and that happened about 4 years ago. So SOFR is kind of the benchmark rate, and then they add a margin to that. So it's usually SOFR plus 1.5% to 5%, depending on you as a borrower, your portfolio, and the amounts that you're looking to borrow. Usually the amount you're looking to borrow kind of drives everything. So in most cases, we tell clients, hey, you don't want to borrow more than like 50% of the account value, so that you have plenty of collateral backup. Because if your investments do fall, if we hit a bad period of time and your investments are off 20%, but you've levered all the way up to the maximum, you're going to get a capital call that says, hey, you either need to repay part of this loan or add more securities or cash to the account to collateralize it. So just margin of safety, that's what we usually look at. So if you have a $10 million brokerage account, having a $5 million floating rate line of credit that's just open and available, secured against your assets, is a great tool. Part of that is also, once you've had investments for a while, you have embedded capital gains that are in there. So if you have a $10 million portfolio, but your cost basis is $7, you have $3 million of capital gains. If you wanted to go get $5 million out of that 10, to do something like buy a piece of land, build another home, live in your current one, and then sell your current home once your new property is ready, you would have to be exposed to at least a portion of that $3 million of capital gains, and then you're adding in tax costs to the project. If you have your $10 million portfolio, you don't actually need to sell anything. You're just able to borrow and utilize that $5 million to do your bridge financing. So it's one of the best tools that we feel like is in the business owner entrepreneur toolkit, and the costs on that are going to be going down. Again, as floating rate debt, that may not be anything that you need to take action on. Your rate may just be coming down. So whether you work with us or not, make sure you're asking about what the current rate environment is and whether you want to utilize that and how much you want to. It could also be a good time, if your account value has gone up since you put those lines of credit into place, to go back and say, hey, I'd like to increase my line of credit availability. Let's take our example, that $7 million account that you had 3 years ago. You may have opened it up and said, great, I'd like to request a $3.5 million line of credit. Well, maybe now you want to increase that to $5 million just for the additional borrowing capacity. And it may actually drop your rate, right? There may be some type of threshold that you hit at $4 or $5 million, depending on your lender, where your rate is actually going to get cheaper. So again, these are all things that you're going to want to look at that we haven't really talked a lot about in the last 2.5 years because interest rates have been moving against us. Now, as you're looking at the business side, this is a great time to evaluate your banking options. I was just at a conference and listening to community-based banks really talk about what they offer to entrepreneurs. And the conversation wasn't great. There isn't a whole lot that they're actually offering that is truly unique and differentiated. They're all trying to grab market share in the markets that they feel like are important to their bank. And it's all about spread versus their cost of capital. So shop those things around. Again, if you haven't looked at this in the last 3 or 4 years, there are probably new banks that are really hungry to be in your market or in your business space or your geographic area who weren't there or weren't looking to expand 3 or 4 years ago. You may be able to take advantage of that with a different rate, particularly if you have business account balances that need a home, right? So if it's, hey, we typically flow, $1 million a month through our business accounts and we maintain a capital reserve of $2 million, it's a very, very, very attractive client for most of these, smaller, mid-sized regional banks who would really love to have you and say, great, I need to evaluate my backup lines of credit. Maybe you have a real estate property that you own for the business and you need to think about a refinance on that. These are all great things to be able to open the door and have those conversations with your bankers and your lenders. So thinking about those, what your line of credit needs are going to be for the business now and over the next few years, and where you want to source that capital. Once you have information on rates, what they're looking like today, you can ask questions about, hey, and what if the Fed lowers rates by another 150 basis points, 1.5%? What do we think we'd actually be looking at? Okay, now you can take that information and build it into your financial modeling and say, how are we going to utilize these outside sources of capital? On the longest term, most complex, if you have SBA loans, so loans that are backed by the Small Business Administration, which are made with a local lending partner, you really want to look at, is now the time to be able to refinance those? What's the value of the collateral asset done over the last couple of years since we put that in place? Do we have an opportunity to be able to get a better deal, maybe a non-SBA product because our loan to value ratio looks a lot better, our business has grown, et cetera, et cetera. So anytime we look at changes in the interest rate environment, talking 3 years ago, we were talking about, great, here's ways that you want to tighten up your utilization of debt, and here's how to generate more yield on cash, yield on low volatility assets, different things like that. We're going to start moving the pendulum back the other way and seeing how do we actually utilize our debt in a really positive way that helps move our family, move our business, and both of those together forward to the things that are important to us. So hopefully this gave you some things to think about in a declining interest rate environment, which is so fun to say after the last 2.5 years of a rising rate environment. It's going to create new opportunities and new challenges. And that's what we always see. The economy is always shifting. Financial conditions are always shifting. Tax law and tax policy is going to be shifting here in 2025 as well. So lots of opportunities to make some new plans, adjust your existing strategies, and make sure you're getting the most out of what you're doing. Hope this was helpful for you. If you'd like any more information to be able to dive into a deeper written version of this podcast or reach out to me directly and ask questions, head over to entrepreneuraligned.com. We have all of the goodies over there and happy to share those with you. Thanks so much for giving me some of your valuable time, and I will be back with you again soon.